Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Enlightened investors, I am your host, Dr. Alan, and I'm excited to explore with our guest how he learned the most important investment lesson from the world's greatest mountaineer. David Rosell is the founder and president of Rosell Wealth Management, an entrepreneurial firm located in Bend, Oregon. For over 20 years, he has specialized in working with affluent individuals and families who are at or near retirement to help them live the life they have always imagined. His company was selected finalist for the management of the $500 million Oregon 529 College Fund. And David is the author of 2 books on financial planning, Keep Climbing, and Failure is Not an Option. So David, share with us a memorable experience from your formative years that helped you to be who you are today.
Oh, Alan, it's good to be on your show here today. It's a big question, but my answer would probably have to be over a 10-year period of time after graduating from college. I made an opportunity to spend a month in 65 different countries around the world. I had a summer business and Mother Nature forced us to shut it down in the wintertime. So I would take that 6 months off every winter and travel to developing countries around the world. And it really helped shape my life at a young age by meeting people from all over the world, having come from a small town in upstate New York, and then meeting people in small villages with different religions, different backgrounds, really helped me realize that the world is vast and yet it's small, and to really go forge ahead forward with a more open mind.
Well, you said that you visited developing countries. Why did you focus on developing countries? That's rather unusual. Most people go to the more glamorous places around the world.
I would say there's a double answer to that. Well, first of all, I started in the easy countries of Australia and New Zealand for their beauty and because they spoke English. I was not a well-traveled person at that time, so that was an easy start. But then I realized that other travelers were coming down from Southeast Asia. And then after traveling to Southeast Asia, I realized, I built up enough courage to go to places like South America and in Africa. And for me, going to the developing nations every day was an aha moment, just seeing things that were completely different from the society that we come from here in the United States. And there was just a beauty to the people and the landscape that I was unaccustomed to. And I knew that Europe probably won't be changing too much over time, but these developing countries around the world are. And second of all, I was a young person. The net worth wasn't overflowing, and the dollar went a lot further in these countries than they would in developing countries.
Well, very interesting. Well, tell us, how did you learn the most important lesson about investing from the world's greatest mountain climber, and who is that mountain climber?
Well, his name is Ed Viesturs, and Ed is probably the best mountaineer that ever walked the planet Earth. He's the only person that has summited Mount Everest 7 times without supplemental oxygen, which many people would say is impossible. He's also summited all 14 8,000 meter peaks and done so without oxygen. But I had an opportunity to meet Ed on a number of different occasions. And the day he said to me that most people think our goal is to get to the top of the mountain, but that is not the single goal of any of us mountaineers. He said, because 80% of the accidents and 80% of the deaths happen on the descent. And it's actually the second half of our journey that takes on the most amount of risk and needs the most amount of planning. And it was that moment that was an aha moment for me to write my first book called Failure is Not an Option, because I realized that as people are climbing their financial mountain and they get to the pinnacle, which is their last day, let's say, of work or with their company, that's the last time that they're funding their 401ks and their IRAs. And now they're going to live on it for 2, 3, and sometimes 4 decades. And it's the second half of their financial journey that also takes on the most amount of risk and needs the most amount of planning.
Well, that makes sense. I have really never looked at it that way. I thought probably you were going to say that the most important part of mountain climbing is actually the journey itself, but it's the second half of the journey that's the most important. Well, that's interesting take on that. A very important concept, by the way. So you say it's all about timing the markets and not timing the markets. So what do you mean by that?
Yeah, money's a very emotional thing, certainly emotional when we're earning it, and it's twice as emotional when we're losing it, even if it's just a paper loss. So we could even go back to all of a year and a half ago, March of 2020. That was when we all realized as a world that this global pandemic is the real deal. And the stock market dropped by 34% in the course of just over 1 week. And millions of people, based on fear and emotion, sold out of their portfolios, got out of their 401ks and their IRAs because they said the 4 most expensive words in the English language is "this time is different." Every time's different. They got out in cash thinking the world was going to implode. And by year's end, the markets had not only recovered, but they were up 80%. Now they're up well over 100% since that low. And now they're sitting in cash where it's too expensive to get back in the market. So we always tell people when you time the market, you got to be lucky twice. You got to be lucky when to get out. And these people did a pretty good job of maybe getting out, but a lousy job of the other half of when to get back in. So we always like to say that it's time in the market rather than timing the market.
Yeah, it can be an emotional roller coaster if you're trying to time the market. It's just, you never know what it's going to do. Even the best financial planners are not particularly accurate about forecasting.
Absolutely. And Alan, as a real estate guru, and I from working in the world of the stock market and financial planning, there's never been a down market in real estate or a down market in the stock market that hasn't rebounded to hit an all-time high. So if you're investing for the short term in real estate or the stock market and you need this money same time next year, I think it's the closest thing to gambling. Mm-hmm. But if you're saying, hey, I want to put this money into the real estate market, the stock market for long-term growth or for my years of financial independence that are 10 years or more out, based on history, it's as close to the sure thing.
Well, what do you mean when you say the return of your money is more important than the return on your money?
Yeah, since the focus of our client base is successful people who are about to retire or they're already in the distribution phase of their life, we always say that getting their money back to them is more important than having these great returns. Another way of saying that is, let's say the market dropped 50%, whether it's the real estate market or the stock market, as they both did in most markets in the year 2008. When that happens, you need a 100% rate of return just to break even. So your $1 million drops down to 500,000. You got to double that 500,000 to get back to the original million. But if the markets drop 10%, you only need an 11% rate of return to break even. When you're in the accumulation phase, younger investors and the markets drop, say 20%, it's actually a positive thing for them because they're funding, hopefully, their 401ks with every paycheck, and they're buying 20% more shares with every dollar. But for their parents or their grandparents who are in the distribution phase, living off those investments, that same 20% market correction, we need to sell 20% more shares that month to give them the same income level. And so that's one of the 8 risks that we face as investors in the second half of the financial journey, the distribution phase, that investors don't in the accumulation phase. So both phases are just as important. To go back to your original question, it's just that the financial strategies and the planning involved with climbing up the financial mountain are often very different than the strategies and the planning in the distribution phase, descending the financial mountain.
So how do you plan for that descending phase, since there are going to be market corrections?
Yeah, there's numerous ways. First of all, it's putting in rates of return in the planning phase that you think you're going to surpass. So lots of times we see people putting in 7, 8, 9% rates of return to have success. And we're recommending, putting a 4.5%, 5% rate of return, knowing that you can invest to do better than that. But there are 8 main strategies that I talk about in my book, as well as on my podcast, These are risks only in the second half of the journey. And there's different strategies, different ways to help overcome each and every one of those risks. But the key is that the only constant in life is change. And any financial plan at this phase in life should not be a set it and forget it approach. So it's updating that plan minimally once a year, because once clients sell their business or leave their occupation and they're living off of their investments in addition to their Social Security and possibly a pension plan, they're getting all their paychecks and playchecks from us. So every year there's changes in the tax code, there's changes in their lives. They're always throwing us curveballs, which is fun, but it's really updating where their money is going to come from and why, especially from a tax perspective.
Well, how do you become financially self-actualized and live the life you have always imagined? That's a different term than what we typically hear.
Yeah, that's borrowing some terminology from Abraham Maslow, one of the greatest known psychologists of his time. And you might remember Maslow's hierarchy of needs. He said you need food, shelter, and clothing at the base before you could think of anything else. And then once you have that, you could think about relationships and love, and then being part of the community and so on. And if you do everything in order, you become self-actualized, is the term he used. And our goal for our clients is to help them get financially self-actualized. Ultimately, peace of mind with all their I's dotted and T's crossed. And one of the ways that we do this is we divide their expenses between what we consider their needs, the necessities, and their wants, or the joy items. And the necessities are things like food, shelter, clothing, taxes, transportation, insurance, and healthcare. These are all expenses that no retiree can do without. And our plan is that we believe that those expenses should be guaranteed for life. So whether there is a trade war with China, a nuclear war with North Korea, whether there's a global pandemic, or no matter what's happening to interest rates or the markets or who's in political office, all these moving parts that affect the economy and the markets, that we're able to tell people that their core necessities are guaranteed for life. There's a number of ways to do that. First of all, we have social insecurity, I like to say, to be funny. And let's say someone had $100,000 of necessity expenses, and $40,000 is coming in from Social Security. Another $30,000 is coming in from their pension plan. They now have $70,000 or 70% of their necessities covered with guaranteed income. Well, what we're recommending is taking a small portion of their portfolio, investing it with an A-plus company that's going to guarantee the other $30,000 a year. So now we're able to say to them, for the rest of their lives, no matter what, your core expenses are taken care of, period. But people don't retire only to cover the necessities. They want joy in their life. And for the people in your audience and our clients, that could include travel and hobbies and purchasing that Class A motorhome, grandchildren. And a lot of people are wanting to cover the education for their grandchildren now. And that is where we're looking for investments that are for the distribution of their phase of their life, with very low expense ratios and a great amount of diversification. And we're all often using exchange traded funds in that area. And then we delve into estate planning, how to transfer their wealth to their beneficiaries in the most tax efficient way possible. And when we do all those things in order, covering their necessities, their joy expenses, taking a look at their estate plan and what things look like after they pass on, they have this certain peace of mind that we call financially self-actualized.
We'll be right back after a brief announcement. Are you a busy professional, passionate about the work of your calling, yet realize that even though you love what you are doing, you're exchanging your time for money? You know that if you were to lose the ability to exchange time for money, your financial well-being will be in jeopardy. If you can relate, I have great news. StateTalker Capital is an investment company designed for professionals to develop financial independence built on solid passive real estate investments. Remove the anxiety of an uncertain financial future and go to StateTalker.com. Get your free one-page 10-step guide to passive real estate investing.
Makes sense. I like that term. different than financial independence, but I think it has even a deeper meaning because it encompasses a whole life, not just finances there. So how do we turn our IRA into paychecks and playchecks?
Yeah, well, I kind of goes back to that hierarchy of needs. I like to call that guaranteed income, that the income checks that come in every single month to cover the necessities, your paychecks. And so on the beginning of every month, with a well drawn out blueprint of distribution planning, you're getting X amount of dollars on the first of the month from Social Security, X amount coming in if you have a company pension, if you're one of the lucky few remaining, and you're getting your paycheck from that guaranteed income source. And then you figure out how much money needs to cover joy. And let's say that that's $60,000 a year, hypothetically. Well, then you have that invested in an appropriate type of diversified portfolio that's rebalancing, hopefully some tax loss harvesting happening in your non-qualified or brokerage accounts. And that is coming in to your checking account at $5,000 a month. And so a lot of retirees have a lot of anxiety when it comes around to how do we turn our investment accounts into these paychecks and playchecks? And there really needs, in my opinion, to be a plan where every year it's updated and it's planned for how much is coming from each account from a tax perspective, and it's hitting your checking account on the first of every month so that you're able to stay within your budget, you know where it's coming from, and there's a plan in place.
Sounds like a good plan there. So it has to be more than Social Security, obviously. So Social Security, we got a raise this year, or a raise is coming this year. And then after that raise came through, they came in and announced that our Medicare payments are going up pretty much equal to the raise they just gave us. So essentially, it's a wash there. So what are the three major risks in retirement that most investors are not aware of?
Well, happy to name three of them. There's 8 that I like to discuss, but interestingly enough, one of them is simple enough, is longevity. Years ago, speaking of Social Security, people would work at one career their entire life. They'd get their gold watch or cut off their tie. And 3 years later, they were no longer with us. And that Social Security was meant to supplement that 3 to 4 year period of time in retirement. Mm-hmm. And now there's so many people that are getting a majority of their retirement income over the course of 3 decades from this program that wasn't really designed that way, which is why it's failing. And so, these days, successful retirees have certainly traded in their rocking chair for a stand-up paddleboard. Graying means playing. So people are retiring earlier and living longer, which means that much more planning or that much more funds need to be in their account when they reach the top of their financial summit. But another one that's really a big hot topic right now is inflation. Inflation is really an important part of planning. Now, even though inflation is hovering around 6% right now, it really averages between 3 and 4% over time. Do you remember what inflation was in 1979, 1980 when Jimmy Carter was handing over the reins to Ronald Reagan?
I don't remember. I think it was in the double digits though, wasn't it?
Yeah, it was over 13%. You were getting 13% in the money market. Can you imagine that? And mortgages were that high as well. Now we're going, I got a 3.2% instead of a 2.85, and we're upset.
Yeah. To
put it in perspective. But let's just say that inflation, because we don't really care about short-term inflation as much. We care about it goes back to the law of averages. And if we were to put in a 3%, 3.5% inflation rate into a plan, mathematically, that means that the cost of living doubles every 20 years. And so if you have a 40-year-old investor and their goal was to retire, let's just say on $100,000 net of taxes at age 60, and because the cost of living doubles every 20 years, we're going to need to make sure that we have enough money in their financial nest egg when they're 60 to be taken out $200,000 a year. And now they retire at 60. And before we know it, 2 decades pass and they're 80 years young. And they're still active. They're still golfing. They're still traveling internationally, doing their River Rhine cruises. How much money does one need to take out at the age of 80 to buy what $100,000 bought when they were planning for retirement at age 40. Well, that doubles again. The 200 doubles to 400. And if you live to age 100, which is the fastest growing portion of our population, centenarians, Hallmark greeting cards sold 75,000 100th birthday cards last year.
Wow.
That 400,000 doubles again to 800. And if you think we're just making numbers dance on paper, if you think about it this way, is you spent more money, Alan, and your listeners today spent more money on their last automobile than their parents spent on their first home. How much did your parents?
About 4 times as much, I would say. Yeah, at least.
Do you remember how much your parents spent on their first home?
Well, I don't know their first home, but when I was in grade school, the home they bought was an $11,000 home, and it was about 11,000 square foot home. But that was kind of a typical home for that particular town. So $11,000. So yeah, an automobile is about 5 to 6 times that.
Exactly.
Yeah.
So that just really puts it in perspective. And that's a really important part of the planning.
Yeah. Well, what is the greatest investment tool of our times?
Well, there's a lot of great investment tools out there, but they're not all great for all people. It's using the right tool at the right time for the right portion of your portfolio. But there is a tool that is great when used appropriately for almost all investors. And I would say that is the ETF, which stands for Exchange Traded Funds. I love mutual funds. I invested in mutual funds since I was a teenager, actually. And 19 was when I first opened up an IRA. And they're still wonderful, but the ETF has benefits that surpass, I think it's the best of owning individual stocks and the best of owning mutual funds. And I dedicate a whole chapter in the book to the benefits of ETFs. But one of those benefits is the cost of ownership. It wasn't long ago that the internal expense ratio, called the 12B1 fee of a mutual fund, was over 1%. And you're looking at under 1/10 of 1% for the overhead to keep the lights on in an exchange traded fund. And only about historically 20% of mutual fund managers get the actual return at the end of the year that's equal or greater to their benchmark index. And the ETFs are designed using computers to track the different indexes and get as close to almost the exact return of that index. So if the S&P 500 is up 25% year to date, the S&P Spider ETF is up exactly 25% that year. So there's a whole slew of reasons of why these are beneficial. But at the end of the day, it comes, most success in investing, no matter what investment strategy you're in, comes from owning all the different asset classes at different percentages based on your age and risk tolerance and time horizons, and then rebalancing over time.
Well, very interesting. Well, David, share with our viewers and listeners how they can contact you and tell us a little bit about your books.
Sure. You can reach me at david@rosellwealthmanagement.com. It's all spelled out. And my last name is ROSELL, wealthmanagement.com. And our office phone number is 541-385-8831. In the books, my goal was to write books on financial planning that were actually fun to read. And readers have told me that I've accomplished that. So what I did is I meshed 2 passions in my life. I early on shared with you my passions for traveling internationally, especially to developing countries, and my passion for helping people with their financial dreams. And I melded those 2. So every chapter starts out with one of my more riveting travel stories. One example would be having serendipitously been in Berlin the day the wall came down, and then linking that to a financial lesson when the impossible became a reality 20 short years later when the financial walls came tumbling down in 2008. And so I feel blessed because it was my first book I'd ever written. Failure's Not an Option, Creating Certainty in the Uncertainty of Retirement. And by meshing these 2 passions, it went on to get a lot of traction and got endorsements from people like Schwab, Ed Viesturs himself, and a lot of icons in the world of business and motivation. And for a first-time author, the book is in its 5th printing, and it's been a joy to be part of that.
Yes, failure is not an option is truly an enjoyable read and informative as well. So get your copy of it, folks. You'll be glad you did. David, share with us one of your most difficult setbacks in life. How did you come through that time and what did you learn from that experience?
Well, I'm going to link that setback to money, financial planning in my career. It was 2008. In almost an instant, the markets plummeted. The S&P over 13, 14 months lost 57%. And real estate in my home market at Bend, Oregon lost 54%. Restaurants and storefronts were being boarded up in our beautiful downtown corridor. And clients were looking to me to stay positive, to keep them positive and hold their hand. And this was at a same time where I needed handholding because I had properties in town and rental properties where tenants weren't able to pay the rent and they had lost over half their value in the stock portfolios. And it was a hard time. And I had to dig deep to not only have positive self-talk for myself, but be there for my clients, because it's really easy to be there for your clients when the markets are going up 25% per year. But it's not so easy when it feels like the world is turned upside down. And looking back, it was a very trying year and a half of my life, raising young kids at the same time and having a staff in a year where my assistant, her net income was higher than mine in 2008. But we don't, great sailors don't come from smooth seas. We really learn from the adversities in life. And looking back, it was a really wonderful learning experience, and I'm able to be that much better of an advisor and put things into perspective that much better for my clients in months like March of 2020, when that COVID episode happened and the markets dropped 34% in 1 week.
So what was the big takeaway from 2008 for you?
As we think, so shall we become. We become what we think about. Money isn't everything. If you are your money and then you lose your money, then by definition, you aren't. I say that because I know of people in my community where they were their money. And when they lost their entire net worth, there's several people that took their lives. And it really helped shift my priorities. Money is important. But what is money? Money for me is freedom. Freedom to do the things that I want to do in life that I can't do if I don't have money. My daughter attends university in New Zealand. And if I don't have the money for that plane ticket, I've lost my freedom to go visit her. But putting money in perspective, we've always heard money doesn't bring happiness. It doesn't bring happiness. But what it does is bring a certain amount of freedom and lack of worry if you've planned appropriately that can add more joy to your life.
Well, David, thank you so much. It's been a pleasure having you today.
Dr. Allen, such a pleasure to be on your show. Thank you for inviting me to be here today.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by StateTalker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, StateTalker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. StateTalker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at statetalker.com.